Since the financial crisis, waves of new rules have taken effect to protect consumers. But at the same time, the rise in regulation has often made it overly difficult for financial companies to serve lower-income consumers. With limited access to credit, the economic consequences often extend beyond the individuals to companies of all sizes and from a range of different industries. Like with all policies, the challenge lies in striking the right balance here, in this case between banking that's accessible and banking that is appropriate, has the appropriate safeguards. Here to weigh in is our group of panelists, and once again, Kelli Grant, who will introduce our panel, and thanks again for coming and being part of the discussion.
Thank you so much for having me. So we have a great panel here for you tonight. I'm going to start all the way down far to my left with Susan Weinstock. She is the Director of the Office of Consumer Policy for the Department of the Treasury, and I know her mostly from her work with Pew Charitable Trust's consumer banking project. I think you have actually a mic behind you, Hollis.
Sorry about
that. There we go. Then we have Bob Stefanowski. He's the CEO of DFC Global. They are a consumer financial services company with more than 1,300 locations in the U.S., UK, Canada, and several other countries. And then we have some new faces for you here that you will not see in your program. We have Hollis Hart. He's a former president at Citibank. I'm going to make sure I have your title correct here. International Franchise Management for Citi. And then we have Diane Lim. She is an economist with the Conference Board and CED, and they are our new Invincibles since the old Invincible has bowed out of the panel. So I'm going to open everything up for you guys with an overview question. What is the best way to ensure citizens have access, safe and effective access, really, to credit and financial products these days? I guess we'll start with Susan.
Start with me?
Sure.
Great. So I started at Treasury about in July, so I'm still new to that role. But we published a paper back in May that looked at marketplace lending, online marketplace lending. So a lot of my comments are going to flow from the paper that we published. So let me just start with our definition of online marketplace lending. It's the segment of the financial services industry that's using data-driven algorithms, online and automated operations, and investment capital to lend directly or indirectly to small businesses and consumers. So Treasury put out a request for information. They got over 100 responses from consumer groups, from individuals, from business, from trade associations, the spectrum of different folks. And then they put out this white paper again, as I said, in May. And as part of that, they had recommendations for this marketplace. So let me just go through those really quickly, and then we'll move on. So first of all, marketplace lending refers to both small business and consumer lending. So one of the recommendations is supporting more robust small business borrower protections and oversight of online small business lenders. A lot of people may not realize that the consumer protections that apply to transactions that consumers make, individual consumers, don't apply to necessarily to small business. If you're using a credit card, it's a different set of consumer protections for a consumer than it is for a small business. Second, marketplace lenders should strive to provide strong customer service from origination to repayment, even when the borrowers are having financial difficulties. So like encouraging companies to adopt standards that would ensure a sound borrower experience from customer acquisition straight through to collections. Third, borrowers and investors need greater transparency in this market. The Treasury recommends a private sector-driven registry for tracking data on transactions, issuances, securitizations, and loan-level performance for the public. Fourth, we support access to credit through partnerships that provide safe and affordable credit. We want to make sure that we're serving borrowers who are creditworthy, but may not be scorable using traditional credit scoring models. These are the so-called credit invisibles, thin file or no file customers. And there's an opportunity to work with community development financial institutions and have them, through partnerships, utilize marketplace lending, underwriting technologies, and back-end operations to provide credit to consumers that will be, maybe at lower costs, And then it's sort of a win-win because then the online marketplace lenders can tap into the knowledge that the CDFIs have of that local community. And fifth, a commitment to exploring innovative uses of open data has been an important focus of this administration. And so, the idea of using machine-readable open data that businesses could use, consumers could use to gain credit, things like that, would be another way that data would be available to help with offering credit. And finally, then Treasury has started a working group of the different agencies that touch the consumer financial marketplace, looking at marketplace lending and data aggregation and things like that. We've met a couple of times, and it's just an opportunity for the various agencies to share their information. But ultimately, I think the white paper wants to encourage positive and safe innovation in an industry that has potential to broaden access to affordable credit, particularly for the underserved borrowers and businesses. So I'll stop there.
That's great. All right, over to you, Bob.
Great, thank you. So my company is actually a subprime consumer lender, so I'm probably not the most popular person in the room, particularly in Washington. And I can remember my prior role was CFO of UBS Investment Bank in London. And when I took this role, everybody said, "What are you're crazy? You're going to go from that to being CEO of a pawn shop?" There's a bunch of reasons I did it. The one that I want to talk about today is I truly believe there's a segment of the population that needs our product. The banks do not serve it right now. Most of our customers cannot get a bank account. The public sector has not found a solution to the problem. The issue with the industry is they got a little bit greedy and they took advantage of people when they didn't necessarily have to. So why did I take this role? I think that we can create a company, or we already are creating a company, that treats people fairly, gives them a product that they desperately need, and provide a solution to this segment of the population that's growing by the day. So what are some of the tangible things we've done? We introduced a term loan product in California and up in Canada. It's still a 60% annual percentage interest rate, but it's not 1,000% like a payday loan is. It's over a 3-year term. We report to the credit agencies for our customers. They can start to build a credit history. As they move up the credit profile, we can move them to even a lower cost product. Things like that where we can help our customers to grow with us. I'd like to offer bank accounts to our customers. Like 90% of our customers don't have access to a bank account. I'd love to be able to do that. Guarantor Loans. My daughter's out at UC Berkeley. She can't get a loan. In fact, she wants a $200 pair of sneakers, and she wants me to put it on my credit card so my wife doesn't see it. But what can we do? I can give her a loan, a guarantor loan. I can backstop it, be the credit behind the loan. She can start to build a credit history, and ultimately, when she graduates, she can get a lower cost loan because she's built that credit history. So I'm sure we'll talk about it a lot here, but this segment of the population needs it. I think the private sector can do it. I think they can do it in a fair way, and I just think they can still make decent returns for their investors without having to take advantage of consumers.
Schizophrenia. I'd like to take a moment to talk about schizophrenia. And that is the duality of the goal, which is financial inclusion, and the acts and the regulation that are in fact getting in the way of that. Right now, there is a tremendous need, and I'm focusing on the segment of the population that I think you touched on, but that fundamentally isn't in the demographic that is being looked at. What has happened over the last few years is that with all of the requirements for KYC and AML, regulatory oversight, capital requirements, and the like, a set of clients, customers, and products are no longer being made available. Well, you're saying to yourself, but wait a second, financial technology companies, fintechs have come along, and they should be able to take this place. They should be able to take the role. Well, the challenge that is out there right now is the approach that the regulatory environment is taking with regard to the fintechs. They would like to be inside the regulated tent. there's a lot of advantages for fintechs. They know that they get to work with people that already have client bases, that have large capital, that know how to work the regulatory market, but they're looking at the burden of regulatory requirements. Thomas Curry recently came out and said, if we give the fintechs a charter, it's going to be on the same basis as the incumbents. Well, that sounds good on the surface, but if you're trying to help a part of the population be able to get inside the tent, start to get these facilities, you need to make it cost effective for the fintechs. Public policy is asking that, in fact, we take care of that segment of the marketplace. But if you make it so burdensome for the incumbent institutions, they're not going to offer these products, and they're not. And they're not going to bring these clients in. But on the other hand, the fintechs, they have no public policy requirements if they're outside of the regulated tent. So the challenge that we have today is we have to think in terms of materiality. What are the risk trade-offs that are being taken by society? And right now, that materiality trade-off is not taking place. The one-size-fits-all regulation is, in fact, keeping this segment unbanked, at worst unbanked, and certainly underbanked. And the challenge then for right now, in order to be able to make the difference, is we need to start having some judgment, and we need to start seeing materiality.
And then Diane?
So I'm speaking on this panel more as an observer of behavioral influences in this market, and also as the mom of 4 millennial kids, 18 to 25. And I think there's tremendous potential because of technological advances in the banking industry to reach more people and to encourage more people to become banked. I see that in terms of the behavior of my kids and the interaction with the financial market, that they are much more savvy consumers of banking products than I ever was. There's a lot of transparency online now. It is easier for people to be encouraged to behave in productive ways for their own financial security in terms of saving behavior, in terms of borrowing. It's easier to comparison shop. 2 sessions ago we were talking about how untransparent the health market is. Banking products are pretty easy, pretty straightforward in terms of the costs and the services that you get. It's easy to compare banking accounts across banks. My daughter did a lot of comparison shopping when she decided to open up an account with Ally, which is a purely online banking company. And I think that kids that are getting involved in taking account of their own financial circumstances, they do respond to the information that's available on an online account. The positive reinforcement that comes from being able to check your account constantly. They're much less likely to overdraw their checking accounts when they can self-monitor their account status. So I feel like the access, the transparency of what is available through technology online these days is promising. And my question to the experts here is that because I'm living in the bubble of my elitist millennial children and don't recognize that they have access to this technology or they understand how to use this technology, and that the underbanked or unbanked population is a very different sort of population. I would also like to say that I think that the more transparent a market is, the less clear it is to me that regulation and rules are needed. Because I'd like to think that the market works, that like bad companies, that bad banks that charge exorbitant fees and have kind of nasty policies about overdraft and things like that, that they will lose customers, and good banks that are very transparent, make their information easy to understand, make their policies affordable, reasonable, that they'll get more customers. So maybe that's my naive view as an economist mom, but that's a question I have for the rest of the panel is, how much do you think we need to rely on rules if the market is working pretty well, at least the market that we see?
So everybody's looking at me, and I'm happy to respond. So I'm going to put on my hat from being at the Pew Charitable Trust for the last 5.5 years and doing a lot of work on overdraft, running the consumer banking project there. We did a lot of survey research on overdraft, and it particularly affects low-income folks. It particularly affects young people. It's a problem that consumers don't understand that they've opted in. Every time we did a survey of people who had overdrafted on with their debit card in the last year, we asked them, do you remember opting in? Because if you remember, the rules say you have to opt in to overdraft. Over half of them didn't remember even ever opting in, and yet they're paying overdraft fees. So obviously there's a problem in the market when you're being charged for something and you didn't even remember agreeing to do it. So that's problem number one. Products are not simple. They're not clear. They're not transparent. That's part of the problem. Bank reordering of transactions from high to low dollar amount is still allowed, and it can take one overdraft. And as the judge in a case many years ago against Wells Fargo said, it's a trick that that bank was using, but many others use as well, to turn one overdraft into 10, because you take the biggest one first, and then every other transaction that goes below your balance now is hit with a $35 fee, and they add up really fast, and that's what pushes people out of the banking system. It's a problem that having those sort of practices is what really makes it hard for consumers. Now, let me say, on a positive note, the FDIC just put out their most recent unbanked and underbanked report, and unbankedness has declined. It's gone down from 7.7% to 7%. And it's been pretty much across demographic groups. So that's a positive a sign that's moving the needle in the right direction.
Okay, so here we go. I agree with everything you said. I think it's a balance, right? One of the things we try to do is educate our frontline people to be transparent. So for example, when somebody comes into one of our stores, they can either leave with cash or they can leave with it on a debit card. And I wanted to get rid of that product because there's a load fee on the debit card. And I was told 60% of our customers really want it. So we kept it. And anybody who wants that card has to read a document, sign it, and say, I want that card. But what do you think happens? You know, probably 10 to 15% of those people don't know what they're reading. They signed it. They get a load fee. They say, I never agreed to do this. So you want to take one stance, it's, hey, you read the agreement, you signed it, you got it. But the stance we take is you need to take time during the sales process to explain to these consumers what they're doing. It's not good enough to put a piece of paper under them and say, sign it. You've got to say, it's purely optional. If you want it, you can have it. Here's what the document said. And that's, I think, where you get the balance. And some of these bad things happen because the communication up front is not precise enough.
But don't you think, Bob, that the online technology kind of helps with that in terms of, you know, there are a lot of things that we agree to, like we were supposed to read an agreement and we just agree to it. And then the fees start, like the automatic, like, oh, you're about to do this, we're going to charge you a fee. Are you sure? Yes. Like, is any of that happening in the online banking stuff?
I worry about, I mean, we have a big online business as well, but I worry about it because in a lot of ways it's less transparent than standing across the counter, thank you, from the consumer and explaining what's going on. The other thing is you look at these algorithms that are being used to underwrite. Well, what are they going to do? They're going to stay away from zip code 06813 because that's where all the credit losses are. At what point is that discriminatory? That you're not lending into a certain demographic or a certain zip code or a certain age, or so everybody's talking about online. It's certainly there. There's certainly advantages to it, but there's nothing like standing across from a customer and explaining to them what they're actually signing up for if you do it properly.
What are some of the other efforts that either you're doing or that you would like to see in the industry to educate consumers before they're signing up for a product or once they're in, or to entice them to be in?
asking me? I feel like
Everybody,
I'm
but certainly for you first.
I'm monopolizing this, but we spent a lot of, we call them CSRs, our customer sales team. We spent a lot of time with our sales team about compliance. We just changed our incentive program to 30 to 40% of their bonus is based upon how they treat customers. So I think it's really that touch point, people having the sensitivity and the desire and the financial motivation to educate the consumer. We're also going to do a lot about financial literacy next year. We're going to go out into the communities. We're going to offer tax planning advice. We're going to open up our stores for people to come in and get help with their tax returns. All of that stuff, I think, starts to help over time.
I'm going to be a touch politically incorrect. One of the major initiatives that Citi had for the last decade has been financial literacy and education. The investment has been tens of millions of dollars each year, and from a purely anecdotal observation, we have just made so little progress. Many of the major financial institutions are doing this today, and we're just, for the amount of money being spent, getting far less traction than I think we should. I have a sense that rather than doing this individually, anecdotally by institution, that maybe we need to step back and look at a much more formal industry training and commitment that starts at an early age. But my own sense is that we've delivered very little value for the literally hundreds of millions of dollars we've spent over the last decade on it, which is, it's frustrating because it's, I believe, genuinely well-intentioned, but the outcome is not what we need.
Let me just add a couple things here. First of all, I think the most important thing with regard to consumer education is that products are safe and transparent upfront. So then in some ways, the need for consumer education is not as great if the products are just easy to understand and safe from the get-go. Having said that, let me also say that part of my office at Treasury leads the Financial Literacy Education Council, which was part of the Dodd-Frank Act. This is a group of 23 government agencies looking at financial literacy. One of the things that they have focused on is starting early for financial success, because research has shown that young people who develop the fundamentals of financial capability are more likely to be financially secure adults. And yet, only 17 states in this country have a requirement in high school that kids take a financial education class. So I think we need to catch kids when they're young, and it sounds like we are not doing that.
Can I back up just a nudge? One of the challenges on the regulation on fairness, suitability, and transparency is that the volume of requirements have driven institutions to create massive documents that, in fact, I think end up with just the opposite result. They obfuscate what should be clear. And so one of the things that needs to happen is to almost create a safe harbor reduction in what is being required. Because at this point, lawyer after lawyer will look at the documents and say, oh, you're at risk if you don't include this comment, or you're at risk if you don't include the section, so these voluminous documents don't get read. In fact, I would like to see a show of hands of anyone here who will admit to reading end-to-end one of these banking documents. One person, stand up and admit that you actually read it end-to-end.
So Hollis, you're playing into all of my cards, so thank
all
you.
Right.
So one of my other cards is, while I was at Pew, we developed a disclosure box for checking accounts. This was one of the first things I did 5.5 years ago. My team read the disclosure documents from the 10 largest banks. The median length was 180 pages long. So we all know nobody reads those things. So we developed a disclosure box. We actually developed a couple of them. We went out and focus group tested them, and then from that we developed one that took into account what we heard from consumers. We then started talking about it with the banks. When I left Pew, all of the top 12 banks had adopted this box. It's on their websites. There's about 35 that we know of that we worked with that using the box.
And actually, when I go online now and look at bank accounts, I find a box that looks a lot like the Pew box from banks that we had never heard of or talked to. So that is great that that kind of transparency is there. And I'll tell you, when my daughter went off to college, she had 2 banks that she could choose that were both on campus. And I was like, oh, how are we going to pick? And then I remembered, wait, both of those banks have adopted the Pew box. So I went online and I pulled up both of the boxes, and I was able, they're not completely uniform because this was a voluntary thing, and we at Pew had pushed the CFPB, the Consumer Financial Protection Bureau, to adopt this box so that all consumers would have access to this. And in the prepaid rule that the CFPB just finalized, they do require boxes on the back of the product that you can buy at CVS or Walgreens and online. So consumers are going to be able to do that comparison shopping. I mean, people talk about that people don't shop for checking accounts. Well, one of the reasons they don't shop for checking accounts is because it's very hard to do so. So we'd like to think that these are, disclosure is necessary but not sufficient in getting consumers a product that they can use safely.
But why do you, Kelli, you've lost total control of this panel, but
I'm just along for the ride now.
why do you think that there's not more people providing financing? I mean, when I look at this term loan we just rolled out, we could be doing 6 times the business we are right now. And if the regulation, I don't want to gang up on you, but if the regulations are working, why aren't there more providers in the private sector willing to do it? Why is there such a dearth of supply if we've got, to your point, if we've got the appropriate balance between, I'll blame it on you, between regulation and consumer protection?
So I don't know the answer to that question. I don't know why banks don't want to lend. I mean, maybe Hollis can answer that question.
Oh, they want to lend.
But they won't go
do.
near it because of the
But small dollar
I mean, the
loans.
difficulty, the challenge, and I think that it's what people really care here is the balance. And it's getting the materiality and getting the right level of regulation versus the risk to the individuals and to society. It's got to be the balance. But right now, the entire segment, and while I'm glad to hear the number is 7% down from 7.7, and that's comforting. We see a large segment of the most vulnerable parts of our community being driven out of the protections of the regulated market and into the shadow activity. And it's because for the cost right now and the risks to these regulated institutions, the risks, and it's real risk. If you make a mistake on KYC and Know Your Customer and AML, the consequences are career-ending. They are. If you were to accidentally open an account for a terrorist, you fundamentally will be unemployable the rest of your life. And the concerns are so great that, in fact, you're fundamentally driving those segments that really need the protections of the regulated market out. And so there just needs to be more materiality. There needs to be, are you going to worry about a $5 or a $25 or a $50 or a $100 account? My instinct is that with the potential today of technology, we can, in fact, take some degree of risk, and so that both sides the unbanked are able to participate and the regulated incumbents are able to do it in a cost-effective and lower risk manner than today.
I get it. In defense of Pew and everybody else, this industry did a lot of horrible things, so the pendulum needed to shift the other way. The question is, how far should it shift to me? But Kelli, I'll stop.
Well, that's quite all right. Well, we had talked within there about the role of tech. Before the panel even started, we have been talking about this in the hallway, as this can be a help and a hurdle for people who want access to either regular bank products or alternatives. Can the panel speak a little bit to some of the benefits and the downsides of technology within this space, in terms of maybe requiring a driver's license for an online account or things of that nature?
I guess
We'll
I'm
start
gonna
with
go.
Susan, since we talked about this.
the IDs can be a problem. There are some municipal IDs now that are coming online. New York has one, Detroit has one. I think LA, San Francisco have developed municipal IDs. What we're finding is smaller banks are taking these as identification to open a checking account, but the larger banks are not. So that's unfortunate. We'd like to see those being able to be used to open a bank account. The other thing that the Treasury looked at in their white paper was in the online marketplace lending was the use of data and data aggregators and how that's working. So this is a big part of this whole fintech world is the algorithms that companies are using to determine your creditworthiness. And there's great promise here. Some talk about this is the opportunity to get to those folks who are thin file or no file credit customers who should be able to qualify for credit, and just because they don't show up on a credit file because maybe they just haven't used credit in a long time, they should be they're perfectly responsible with credit and would be good borrowers given the opportunity. But then there's the risk of that as well. So we need to find the balance. There's a concern about disparate impact. There's a concern about fair lending. There's a concern about the data that goes into those algorithms. What if it's wrong? A consumer can't correct that. You don't even know what's in the algorithm. How would you possibly correct that? Whereas under the Fair Credit Reporting Act, you can go to the credit reporting agencies and you can correct, you can ask to correct what's in your report if you find something wrong. So it raises lots of neat opportunities, but there's also some risks. So we have to figure out a way to balance out those two.
One of the earlier speakers talked about moral hazard, and I think that one of the questions that's out in the marketplace now for consumers is to understand when are they dealing with somebody that's within the regulated sphere and when are they dealing with someone outside, so that the question has to be, and again, it can be on the lending side, it can be on the investing side, it can just be on the remittance and money transfer side. And right now, we in the marketplace, it's gray. And so if you deal with somebody today, you don't know if you've got the protections or not. I think that's one of the areas that there needs to be more initiative taken to define what's in and what's out so that people have clarity in terms of understanding what they're dealing with.
Can I try to tie back to financial literacy and the technology?
Of course.
I think one thing to keep in mind, we kind of talk about how you're never too young to learn how to be financially literate, but in some ways you could be too young, in the sense that a lot of our kids are taught a lot of things about like how the government budget works, how compound interest works in school. But then, honestly, they kind of forget about it for a few years, and then they actually graduate from high school and get a job, and right at that time when those lessons need to be fresh, they're not fresh anymore. So I think there's a need for a little bit more financial literacy that is somehow delivered at the point of in your life when you need it. Like, you need that refresher course right when you start your first job, or,
Who do you see that responsibility falling on?
Well, part of it, I think, is market-driven in the sense that banks, it should be in banks' interest, in the financial sector's interest, to make their products easier to understand and more enticing to people that are grown adults going into the marketplace. I think that, for example, one part of financial literacy is not just about the importance of saving, but the importance of teaching young adults that sometimes it's okay to borrow, that there are good reasons for taking out a debt. So I've read that behaviorally, a lot of students or a lot of potential students are reluctant to go to college because they're reluctant to go into debt, to take out a loan. So I think part of financial literacy is encouraging saving, and teaching adults who are already working the value of saving and reminding them about the principle of compound interest. But I also think it's re-educating them about, or educating them in the first place, about good reasons to borrow and good loan products as opposed to bad loan products.
I feel like, Hollis, you have a response to that? No? You're giving me the eye.
I think the research shows that really what works best for financial education is just-in-time education.
Yeah.
And I think that, that first summer job is an awesome time to teach that to kids. Now, who does that and how it gets done, I don't have the answer for that, but it seems like that would be a great time to make that happen. They're getting their first paycheck, maybe even opening their first bank account. That just-in-time moment is right there. How much are they going to put into savings? How much are they going to spend on those $200 sneakers? Are they going to, are they going to buy those $200 sneakers, or would the money be better off with something else?
My wife finds out she won't.
So I think that the research has definitely shown that that's just-in-time is really key, and it's a matter of how do we make that happen?
Well, and some employers do a good job.
Yes, that's right.
I remember Susan and I worked together at Pew. We had people that would come in and give us financial planning advice. Remember that? So, I think that that it is possible for employers to do a little bit more to help their employees on matters beyond the business practice.
And going back, Diane, to the whole behavioral thing,
Yeah.
I remember back in the day when 401ks just started out, employers thought, we should give them 15 choices so they'll have lots of
Right.
things to choose from. And what behavioral economics showed was actually when you're given 15 choices, you shut down and you say, there's too many choices, I don't know what to do with this, I'm walking away. And so a lot of employers got that message, and they've winnowed it down to a lot fewer. And then the Pension Protection Act allowed employers now to have their employees opt in. They're automatically opted in. They have to opt out if they don't want to be in the 401k. So you're always you're put in there originally, and then you have to actually say, I want out. That's a good thing, because that gets consumers into the retirement savings automatically, and then they have to act not to be. So, and that's a good thing for all of us.
And now, we've talked throughout this panel about the number of millennials that fall into the unbanked and the underbanked. How do we help them, I guess, graduate to being fully banked, or is that even the goal?
Well, I think going back and putting my Pew hat on again, the research Pew had done certainly showed that folks who have a bank account fare better in economic downturns. Pew had done a study of low-income Los Angeles area households, gone door to door in 2009 and went back to them in 2010 and said, you had a bank account in 2009, do you still have a bank account compared to those who didn't in 2009? And what they found, and so this is in the midst of the Great Recession, those folks who kept a bank account were better able to save. They weathered the storm of the Great Recession much better than the folks who didn't. Now, this was not statistically significant research, so I don't want to put it out there that it was, because it was just one neighborhood in Los Angeles. But an interesting story of how the power of that bank account to help people save. There's a place to put your money that won't get lost or stolen. Part of that survey research also showed that I can't remember the numbers now, but an extraordinary number of folks who didn't have a bank account and just dealt in the cash economy lost or had stolen their cash. And it was 2 weeks worth of expenses, and these are low-income area households, low-income households. So they couldn't afford to lose that kind of money, and yet they did. Whereas if they had it in an account, it would have been a much safer place to put it.
And I did want to ask our industry folks here, can you talk a little bit about how you combine protecting consumers with scaling the business to have that balance between serving the consumer and serving the business?
I think on the front end, it's relatively easy, because the bottom line is, even if I wasn't a nice person, which I think I am, but I'm not going to lend to people that can't afford to pay back. We turn down about 40 to 50% of the people that apply for a loan with us. And we're overly stringent, because I don't want to put somebody in debt that they can't pay back, and I'm trying to build a company that I can be proud of, and I've got 3 daughters and, the whole 9 yards. The harder one is the collection side. We tape all our collection calls. And, you know, where you've got somebody that is honestly trying to pay you back, or they lost their job, those are the hard ones, right? Those stick with you for a while. Now, on the one hand, I'm not the American Red Cross, right? I'm not a charity. I've got a private equity owner that needs to make a return, and they've put $1 billion into my company. On the other hand, if somebody's honestly trying to do the right thing, how do we train our collection people to give them the latitude to pay the debt over time, to restructure it, or if it's never going to get paid back, to just say, okay, we're done and we're not going to harass you? I think, you know, the growth side is easy because you've got that binary decision as to whether you lend to somebody. It's more the collection side that becomes very hard.
Do you have a comment, Alice, or should we?
Well, I was going to change the topic, but if you've got a
Of course.
question.
No. We're going to be wrapping up and going to Q&A soon based on my time clock here, but.
Well, you'd asked earlier the question about how do we get more financial inclusion and financial technology. One of the big differences when you look around the world are there two different sets of national public policies. There are a set of countries that have proactively said, we want to reach out and bring the financial technology companies inside the tent. So for example, Singapore set up a $25 million fund that's intent is to bring some of these startup young companies in and bring them into the system and leverage these financial technologies. Switzerland, amazingly to me, has gone through and said, how do we change some of our regulations so that we can adopt and adapt to what's happening? So they've moved from signature-based, requiring that on documents, to now taking electronic signatures, electronic approvals. These are small things, but national agenda and public policy that's reaching out proactively and saying, we want to encourage our regulators, we want to encourage our government officials, we want to encourage our incumbents to leverage this technology. We think that's going to help us grow our GDP, grow our jobs, and be more effective. So in fact, I know that in the US, we're still reacting very strongly to the crisis of 2008 and all the pain. But so much of the focus has been to make the institutions simpler, safer, and take the technology outside of the regulated sphere. Maybe one of the things we need to revisit is whether we, in fact, can make the entire economy safer and simpler by bringing the technology inside the regulated sphere as appropriate.
So can I just make a couple comments? So first of all, another one of these that Hollis did mention is in the UK, where they've developed this, what they're calling a sandbox. I think they had 36 companies apply, I think that's the right number, to offer products in the sandbox. The interesting thing to me about the sandbox is that the consumer protections, so the idea is that sort of these are pilots that companies can bring to market without having to go through all the regulatory hurdles. However, there is a floor, and the floor of that is the consumer protections are not negotiable. You can't say, I want a waiver from this consumer protection in order to offer this product. So that's a really interesting model. Now, I should also say that our government is working on this. The Consumer Financial Protection Bureau has Project Catalyst. They will offer firms that come in no action letters saying they come in, they walk through the product with the CFPB, and the CFPB will work with them. And if the CFPB feels like this is a product that should be piloted, they'll give them what they call a no action letter, so that there would be no enforcement actions against them if the product doesn't work out as planned. The Office of Comptroller of the Currency, I think it was just last week, announced that they're going to open an office in New York and another in San Francisco, and they're going to do a similar sort of open office hours working with companies that want to bring products to market. So I think the government is looking at this. I think they're trying to figure out, we've got this non-bank sector that is not really very regulated. We have the banks that are highly regulated. How do we make this work so that consumers and the economy and everybody benefits, and that it doesn't, cause some sort of risk to all of us that could really hurt the economy?
That's a great point to end it on, I think, and we'll go over to Q&As. We've got some bright spotlights here, so I'm going to let There are folks coming around the room with microphones, so I'm going to let them choose who goes and asks the question, because we can't really see you too well.
Sorry. Thanks for being here. Whenever I think of banking these days, I think of what are you going to do about Elizabeth Warren and the fact she thinks that you're all a bunch of criminals trying to line your pockets and rip off innocent Americans. Whether she actually believes that or not, I don't know, but it seems like she does. And it seems like, whether you like her or not, she's there, and you're going to have to deal with her. You're going to have to somehow convince her to go along with whatever you want to do, regardless of who's present.
I guess that's me or you. Huh? Listen, I'll be honest with you. When we're owned by a company called Lone Star Capital, when they looked for a CEO for this company, people were not lined up around the block applying for it. In fact, I think they got stuck with me at the end of the day. But I just think, it's going to sound corny, but if you do things right, if you have high ethics, to the discussion before this, 50% of my senior leadership team is women. I've replaced 28 of the top 30 people since I showed up at the company. I got people that live the values. I treat the customer right. The economy needs this product. I got to believe at some point people are going to have common sense and come around and say, hey, you're not the devil incarnate. You're doing a good thing. Am I at personal risk right now? Absolutely. Do I think about that a lot with 3 daughters? Absolutely. But it kind of is what it is. You just got to hope, I think, that, and the fact that you're up here, I think, is terrific. I just think we need to have more dialogue, because I think both parties have the right intention. It's to serve this section of the population. But I can't tell you, when you see, the guy from Wells Fargo in front of Congress, I'm sitting there thinking, when am I next? And I think it's ultimately, you should talk, House, but I think it's ultimately going to hurt the amount of talent that goes into financial services, which maybe that's what people want. I don't know.
Yeah. My instinct is that Elizabeth Warren is echoing the views of a significant segment of the population. So it isn't Elizabeth Warren per se. I think there needs to be, well, first of all, the economy needs to be felt to be stronger so that a significant percentage of the population doesn't feel as uncomfortable, as fearful as it does, and as a consequence are not going to feel as much at risk. My instinct before the election was that we were looking at a decade in which the United States would have a national public policy that was much more restrictive than many of our global competitors with regard to the financial services industries, insurance, broker-dealer, mutual funds, not just banks. I'm not yet feeling that, in fact, there is going to be a sea change. And I don't actually think about it in terms of the regulators, because I think they're echoing again the lead that they're getting from the Congress, and the Congress from the people. So if you're asking, in terms of what's going to happen, I am concerned that there will continue to be tremendous pressure to move the regulated incumbents into being utilities and move innovation outside, which will have 2 effects. I think it will make the regulated entities simpler and safer, but actually make the environment outside more volatile and more risk as you have less liquidity and other types of issues in the marketplace itself. But my instinct right now is I would be anticipating another 5 to 10 years of the U.S. being in a small but significant group of countries that isn't going to continue to be heavily regulated. I don't think we're going to reverse that, and we may see other countries try to use this as an economic competitive advantage.
I'll just finish up. When I meet with the regulators, and I mean it, our interests are perfectly aligned. I don't want to do bad things to people. We had a bondholder call the other day, and the first question was, Trump's going to get rid of the CFPB. How does that change your strategy? I said, it doesn't change it one iota. We're building a company that we want to be proud of. We're going to put socially compliant products out there. And it's almost irrelevant to me what the regulators say, because I'm going to do it anyway. And I think if you take that approach, you worry a lot less about the Elizabeth Warrens of the world.
Microphone is making its way up.
Hi, my name's Kim Nugent. I have spent 25 years working in human resources, and currently I'm early retired and volunteer 2 days a week at a charity that benefits homeless families with children. Coming from that perspective, the discussion about when do we teach financial literacy, I have always questioned why we don't teach it in high school. I think that it's a message that, or a learning that has to be taught repetitively over the course of people's lives. There's appropriate information to share with kids in middle school. There's appropriate information to share in high school. Appropriate information to share before they start a job or while they're in the job. But if we leave it, every one of those steps to others, the parents, to the financial marketplace, expecting the bank to tell someone when not to take a loan or when to take a loan, we see what we saw when we had the mortgage crisis, leaving it in the hands of, people to supposedly learn on their own. We find that the learning wasn't there, it wasn't good, and it didn't protect them. And so I think that in response to the last comment about regulations, I think that they go up in proportion to the lack of feeling that our public is prepared to protect themselves. And that if we can change that balance, wouldn't we find ourselves in a better place altogether? So how do we get this education to be improved? Why are we prioritizing some skills that, albeit are great from an employment perspective of foreign language and higher maths and sciences? Why do we prioritize that over base life skills such as knowing how to read a contract and how to get a bank account and balance the checkbook and understand interest and so forth?
It's a great question. I don't know the answer.
I don't know. Why?
Well, I think you stumped the panel there. I think another way to look at that would be to say, how do we prioritize financial literacy? We talked about different groups that might be responsible for this. Do we feel like this is a public policy issue that needs to be addressed? Is this coming from the company level? What would the panel say to something like that? Where should this effort be coming from?
This is a fundamental public good issue. Because there are social benefits to everyone being more financially literate. And, there is sort of the classic free rider problem that no one person, everyone would benefit from greater financial literacy. Our whole economy would function better if people were more financially literate. But, who wants to pay for it? Who wants to be the one to? So that's why it does suggest there should be a strong role of government in educating, improving financial literacy, I would say.
I think also fintech offers some possibilities here. Personal financial management tools like Mint that make it very easy to put all of your information together and sort of see the inflows and the outflows of your finances is a helpful thing. Low balance alerts for checking accounts so that you get a text when you go below $50, so you know that, oh, I'm gonna incur some fees if I don't put some money into this account, or I'm going to stop spending if knowing that I only have $50 in the account. I think there are some possibilities there. One of the big issues we have now in this economy is folks who have these volatile incomes. So they don't, you drive an Uber or you work in retail. One week you work 30 hours, the next you work 12, and the next you work 40, and there's no way to make a budget not being able to know how much your income is going to be on a regular basis. So there's a product I think it's called Even, that takes money out of your account on the weeks when you earn more And on the weeks when you earn less, it takes money that you've already held out on that week that you earn more and gives it to you so that you'll have a balancing out of your income. So that's another product that could be helpful. I think there's others out there in the marketplace. So I think there's that opportunity. And I don't know if that's financial literacy per se, but it is tools that help people manage their money.
And I think we have time for one more question. In the front.
So I wasn't intending to comment on that particular point, but I actually have experience with a nonprofit in Florida that's very akin to what you have here in D.C., Martha's Table. So it's actually a nonprofit that actually tries to break the cycle of poverty. And what we've done with that early learning center is actually reach out to the moms, to the parents, and actually provide financial literacy for those family members as well. So they actually are moving through that cycle. But where I wanted to go is more along the lines of I've had the fortune of being the CFO of some pretty good-sized companies and never had a problem with getting credit, associated with and lending associated with those companies. But in the middle market area, what I'm hearing a lot of in terms of the companies that are in South Florida is that regulations have become so onerous that it's really, really, really hard to execute a loan for some of these small businesses, small to medium-sized businesses. So I don't know who we've got in terms of thought about as the definition of serving the underbanked, but I would submit to you that at least, and maybe it's not a broader experience that's being felt, but I think from the small and middle-sized businesses, they ain't getting the loans because it's getting really, 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 really hard for the banks to actually execute against it. So I don't know if that's something that you're seeing.
Yeah, I'll hit that one because we do have an initiative to do it. We've got 100,000 of our commercial check cashing customers also own small businesses. So we're just starting, but we've got a joint venture where we're going to start to lend to small businesses. Right now we're not online, so it is a pretty labor-intensive process. I'll give you that. But I think the small business segment is as underbanked or undersupplied as consumer lending. But again, with the regulations, with the amount of capital under Basel III that people have to put up against those loans, none of the banks want to do it. What's that?
Even $100 million size company,
Right.
200,
You get
300.
you get to anything
They
other
don't
than
wanna do
an
it.
investment grade credit, the amount of capital they have to put against that loan, they can't make money.
Yeah, I just want to make quick. I was a bank audit chair, and first of all, when you have these check disclosures online, it's very easy to check it and never read it. What we don't have is something flashing that gives case studies or examples or will alert you to help you. Secondary, the people, the reps in the banks, they don't know this stuff. And thirdly, we haven't gotten to the core issue of financial literacy, and I think we can teach a lot of this with apps. And for example, Universal Studio has developed games to teach poor kids calculus and math. There's a lot of things we could do with the power of story, games and stuff like that, and I'd like to see us use some of the CRA funding to deal with the fundamental issues of literacy, particularly for children and women, because women really need this to understand the importance of money.
So there's a group called Doorways to Dreams. I don't know how many of you have heard of them. They've been working with credit unions to gamify savings. So every time you put in like $25 into an account, you're entered into a lottery, and at the end of the month, you can win, I don't know, it's like $5,000 or something. So it's an incentive. People love to play the lottery, and 99.99999% of the time lose. So this is a win-win. You're putting money into savings, and you might win some extra money. It's a really neat idea, and if you're interested, you can go on their website. I think it's d2d.org, and they have lots of descriptions of the work that they've done and how successful they've been.
I think we have time for one more question, sir.
Yes, thank you. I think our former Citibank panelists comment a little bit about the technology side, or I think a little bit on either microfinance. I was curious as to taking things further, talk a little bit about PayPal, talk a little bit about if, in fact, you do have this adaption of technologies, how much should either government or policy be involved in regulating that, and how much of that should be among private sector?
I'll just say one thing about PayPal that people may not realize. So the new prepaid card rule that the CFPB just finalized is actually, it covers prepaid accounts. So if you fund a PayPal account with your money and then you spend out of that account is covered under the new prepaid card rules, prepaid account rules. So Google, I don't know if Google Wallet still does that. For a time, you could fund a Google Wallet, you could fund an account in Google Wallet. I think they stopped doing that though. And then you could spend out of that. So what I'm saying is those pre-funded accounts with like sort of they've taken deposits, those